Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at three large cap stocks to consider buying before their upcoming earnings releases and possibly holding as part of a long-term diversified portfolio. And the three stocks we're looking at today are Walmart, Intuit, and Home Depot. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. And before we jump into the three stocks we're looking at today, which once again are Walmart, Intuit, and Home Depot, I quickly just want to go over where the broader market stands. I'm recording this on Thursday afternoon, just to give a better sense of possibly these three stocks, and then just as I said, the market as a whole before you consider buying anything. So inflation and interest rates grabbed all the headlines earlier this week after that January CPI release came in slightly hotter than expected, which is forcing Wall Street to kind of once again recalibrate their expectations for when the Fed is expected to cut interest rates. They had already backed off the idea that they were going to cut in March back in January, and now traders are pegging roughly 50% odds the Fed's going to now have to hold firm again in May, which is a really big change from 0% chance just a month ago and about 36% last week. So they're just slowly pushing their idea of when the Fed's going to cut back or cut rates until possibly now the back half of 2024. But it's worth noting that Powell has obviously stressed that he's not going to declare a premature victory, which is honestly a good sign. It's better that the Fed just kind of maintains things for a little while before it just all of a sudden just slashes rates and things go crazy again. That would be a much worse situation than them kind of holding firm, especially as the economy remains seemingly so strong 6 weeks into 2024. And as the earnings outlook continues to look impressive. So we saw that first wave of buying earlier this week, and then midweek buyer stepped in right at that 21-day moving average, which is once again proven to be a place where the bulls are going to step in so far in 2024. Obviously, we're still a little bit extended over that 21-week moving average, so we could see a bigger pullback in the somewhat near future, which is a healthy part of all markets. It's worth remembering that at all times, that if you're a long-term investor, these pullbacks shouldn't be seen as scary. They should be seen as a chance to buy more of your favorite stock at a lower price. And as I mentioned, or maybe have not mentioned just yet, the earnings revisions continue to be impressive. So far into the fourth quarter earnings season, things are looking much better. We're now calling for a 5.5% earnings growth for the S&P 500 based on the latest Zacks data, which is up from roughly flat earnings just a month ago. So that's really a great sign to see the results coming in really positively. And overall, the better sign is that so far the guidance for 2024 has been strong. So we're still calling for about 11.1%, so 11% adjusted earnings growth in 2024 for the S&P 500. And then if we look ahead to 2025, obviously these estimates are definitely going to change. By then, we're calling for 13% adjusted earnings growth next year. So another great sign in terms of the longer term outlook for earnings for the S&P 500. And at the moment I'm recording this, the market was a little indecisive. We had the S&P 500 up marginally and the NASDAQ down marginally on, as I said, Thursday afternoon after that nice comeback Wednesday. After that first big dip in a few weeks to start the week on Tuesday, that, as I said, bulls stepped in right at that 21-day moving average. So as long as the next wave of retail sector earnings are able to come in strong, we could see the market continue to just chug along higher. And speaking of retail earnings, we're going to take a look at Walmart as the first one of these three stocks we're looking at today to possibly consider buying and holding. And Walmart trades on the ticker WMT, and the company is set to report its Q4 fiscal 2024. So they're just on a year ahead in terms of what they call their fiscal 2024. On Tuesday, the 20th of February, the market is closed on Monday for President's Day, just for anyone who might have forgotten that or not known that. So Walmart stock is trading near its all-time highs heading into that report, with its shares up about 17% in the last year. The company's offerings, everyone knows what Walmart is, are vital at all times to consumers, and perhaps most of all amid ongoing inflation and fears of just a slowing economy, and more people are flocking to Walmart when they're looking for deals. As we said, the inflation report came in slightly higher than projected. More people are looking for deals, and Walmart is benefiting from that. So obviously, like everyone in retail, they're now offering as many different ways to shop as you want, from delivery and pickup and anything under the sun. They've rolled out various offerings to compete against Amazon and Target. They have their own subscription service called Walmart Plus that offers a tons of different features and benefits to those users. They're also focused on partnerships with popular other like digital native brands, and they're trying to grow their own third-party marketplace like Amazon. On top of that, along the same lines as Amazon, they have a growing advertising segment as more customers are starting their shopping searches on Walmart.com. And going into some of the growth recently, the company's U.S. comparable sales jumped about 6.6% last year, and they're up 13% in a 2-year stack. Meanwhile, its e-commerce segment climbed by 12% last year and 23% in a 2-year stack. And this isn't even including the big initial COVID wave of that big comps growth and e-commerce growth. So overall, Walmart has roughly doubled its e-commerce business over the last 3 years. So that includes that COVID boom. Walmart's also crucially continuing to innovate and push forward into new tech-focused areas of automation, which is going to be a key thing going forward at its warehouses, stores, and beyond. As I said, once again, to compete at the highest level for the longest time against the likes of Amazon, and who knows, maybe another competitor down the road. It generated, just to put the company's size in perspective, it's just worth remembering they generated $611 billion in revenue last year, which was its fiscal 2023. That topped Amazon, which was at $514 billion, and Apple and ExxonMobil. So Walmart is, sometimes I think people forget just how big of a company it is. And Zacks estimates call for Walmart to post about 5.5% same-store sales growth in 2024 in the U.S., and then 5.5% higher total revenue growth this year, and then 3% higher sales next year to get all the way up to $666 billion. Walmart's adjusted earnings are projected to jump 3% this year and then 8% higher next year. And it boasts a pretty impressive history of bottom line beats, including an average of 8% in the trailing 4 quarters. Walmart currently lands a Zacks rank number 3 hold at the moment, and the stock has climbed about 68% over the last 5 years, which lags the S&P 500, but tops its retail sector, which is up 42%. And then over the last 6 months, the stock's up about 6%. It had hit new highs heading into its last earnings release in Q3, and then the stock sold off. It had gotten a little overheated, and it posted slightly disappointing guidance, but the stock has pretty much regained all of those losses and now trading just slightly below its all-time highs heading into its release. It's back above its 21-day moving average, and we could see some selling. As I said, things are looking a little overheated at the moment for the market as a whole. Walmart's trading pretty solidly above its 21-day moving average at the moment. So it will always pull back to the 21-day or 50-day at some point. So if you're trying to get in and out of these stocks, those are things to look at. But if you're a longer-term buy and hold investor, you don't necessarily need to try to time things too precisely, because that can then cause you to just kind of miss out for longer periods of time while the stock goes up as you're waiting for the, quote, exact right moment. We should also remember that it's still trading about 8% below its average Zacks price target and at a 10% discount to its highs in terms of forward earnings. So it's trading at 24.1 times forward 12-month earnings, which is only a slight premium to the broader Zacks retail sector. And then exactly 22 of the 31 brokerage recommendations that Zacks has for Walmart are at strong buys, next to 4 buys, and there are currently no sell ratings for Walmart. Its dividend yields 1.4% versus its industry's roughly 1.8% average. And obviously, Walmart is hardly a flashy stock. Everyone knows Walmart's business, but it's definitely a worthwhile consideration as part of a healthy and diversified portfolio. And it's always worth remembering, too, that even in good times and bad, Walmart's going to be there, and inflation's still a problem for a lot of people. So it's certainly worth considering Walmart at the moment heading into that release next week. And now we're going to transition onto a totally different company and a totally different realm of the economy, and that is Intuit, which trades in the ticker INTU. The company is set to release its second quarter fiscal 2024 results on February 22nd. So let's just kind of jump right into Intuit because it's not as household of a name as Walmart, though some of its products might be more well-known than the company itself. Intuit, which is probably most famous for TurboTax, which some listeners might use and lots of people use, has a growing portfolio that includes QuickBooks, Mint, Credit Karma, and MailChimp. It currently offers various tools and software for taxes, accounting, small business money management, alongside email marketing, digital ad services, customer relationship management, credit scores, and other personal finance services. Intuit's array of offerings help it benefit from the expansion of multiple key segments of the economy that are unlikely to go out of style anytime soon. It boasts over 100 million global customers, and it grew its revenue by between 11% and 32% for 7 years running. Intuit expanded its revenue from under $4 billion in fiscal 2013 to $14.4 billion in 2023. Which fit its fiscal 2023, and its revenue is projected to climb by another 12% in 2024 and 13% in 2025 to get all the way up to $18 billion. And current Zacks estimates call for its adjusted earnings to jump 14% in 2024 and then another 13% higher next year. Intuit's earnings outlook has held up rather well over the last year plus, though it sits at a number 3 hold right now. And then in terms of its stock price performance, its shares have skyrocketed roughly 2,800% during the last 20 years to blow away the Zacks tech sector, which is up 500%, and Microsoft, which is up 1,400%. Intuit has also more than doubled the tech space over the past decade, and the stock's up about 62% in the last year and still trades slightly below its all-time highs. Heading into that release, the stock recently found support at its 21-day moving average amid this nice comeback for, as I said, last year, it's up 62%, and it just found support at its 21-day moving average. And Intuit is hardly a value stock. That could maybe scare away some investors, but it is worth noting that Wall Street's been willing to pay up for Intuit for over a decade, and they might continue to, just because of the consistency of its business and its expansion into new areas. As we sort of alluded to, it's worth noting that MailChimp is a business that it acquired during the pandemic, and so is Credit Karma. It did that. So it's worth noting that they've expanded as well. So they could continue to do that going forward with their solid balance sheet. But as I mentioned, it's not a value stock. It's trading at 53.4 times forward 12-month earnings, which does, though, mark a 30% discount to its own 10-year highs. And as I said, I alluded to, its balance sheet's really strong despite making those 2 big acquisitions over the last several years. It boosted its dividend payment this year by 15%. And it has nearly $4 billion remaining under its current repurchase program. And Wall Street's really high on the stock with 22 of the 27 brokerage recommendations that we have coming in at strong buys. And the last stock we're going to talk about today is Home Depot, which trades in the ticker HD. The company is set to report its fourth quarter fiscal 2023 results on Tuesday, February 20th. Home Depot is the world's largest home improvement retailer. The company operates roughly 2,300 retail stores in all 50 U.S. states, D.C., Puerto Rico, various other places, and in Canada and Mexico as well. The home improvement power posted about 20% revenue growth in 2020 and then 14% higher sales in 2021. Versus an average of around 6% top line growth during the 5 years prior to that. So that was that big COVID boom. Meanwhile, its adjusted earnings surged by 17% and 29% respectively. So that's kind of the base we're working off when you consider what Home Depot's near-term outlook is. They were obviously never going to be able to keep up that scorching pace for a company of its size and age and its business model. As the economy returned closer to normal, sales still climbed 4% in 2022. to help boost its adjusted earnings by 7%. That said, Home Depot's annual sales are projected to fall for the first time since 2009. In 2023, we're calling for its sales to fall by 3.5% to $157 billion. Oh, no, excuse me, from $157 billion to $152 billion, and then climb back by 5% next year. Meanwhile, its adjusted earnings are set to slip 10% in 2023 and then bounce back to the tune of about 4% growth next year. Home Depot's longer-term outlook remains pretty firmly intact. It just was going against an odd period of everyone moved and remodeled and did all of those things kind of all at once instead of maybe spanning it out over a 5-7 year stretch. It did it all at once. But overall, their outlook remains rather heavily intact since millennials are now driving the housing market and baby boomers are finally retiring and moving. Plus, it's worth remembering constantly that home builders did not overbuild during the recent COVID boom, which means there's still plenty of upside. And they didn't overbuild just during the last decade. So there's still tons of needed inventory in the housing market. So long-term, Home Depot and lots of these companies in the wider space that they operate in will benefit from these trends. Home Depot currently lands a Zacks number 3 hold, and its earnings estimates have held up really well over the last few months, which is a positive sign. And actually, its most recent, most accurate estimate for the upcoming fourth quarter results are coming in about 3% above consensus. So that's a positive sign, and up slightly for 2023 and 2024. So that's a good sign. And the company has topped our estimates by an average of about 2% in the trailing 3 quarters. On the brokerage recommendation front, we have 28 brokerage recommendations, with 17 of those coming in at strong buys next to no sells. Its dividend is yielding about 2.3% at the moment, and it's raised its payout by about 13% on an annualized basis over the last 5 years. And then in terms of its stock price performance, its shares have climbed 366% over the past decade to blow away the S&P 500, which is up about 180%. And top its Zacks Econ sector, which is up about 150%. The stock is, though, roughly neck and neck with the benchmark over the last 5 years, and HD is up about 17% in the last 3 months, yet it still trades around 14% below its all-time highs, which is a positive sign. The stock, like Walmart and a lot of these stocks, as is the case with the market, just found some buyers at its 21-day moving average, and it's sitting at roughly neutral RSI levels. And then in terms of valuation, it's trading at a 12% discount to its own 10-year median at 22.9 times forward 12-month earnings. So like with Intuit and Walmart, it's certainly worth considering Home Depot heading into its upcoming report. If you're trying to play these stocks just for an earnings pop, that's always much more risky. But if you're looking for some longer-term investments that are part of a diversified portfolio, it's certainly worth considering these 3 large-cap names that have proven their businesses are not going anywhere, and they're going to be here through thick and thin for years and years and years to come. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute, an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.